right. Hey guys, Ty the real estate guy. I'm here with Jeff Morgan, my most trusted lender and one of the smartest people I know.
Not the smartest.
He's a lot better at the mortgage stuff than I am, obviously. This is our first live broadcast, so forgive us if there's a little shakiness or whatever. And we are planning on doing this every other Thursday. And the whole point of this show is to get you out ahead of the market. You know, let you peek around the corner, see into the future. So you know if it's good time for you to buy or sell a house.
Absolutely.
Yeah. So part of why I like having Jeff here is because he understands the numbers a little bit better than I do. We can talk about housing affordability, where house price is going. I'm going to tell you that. Jeff's going to talk about mortgage rates and how that applies to you, the consumer, the buyer or the seller, and how affordable your house is going to be, or if it's a good time to sell or buy. So with that being said, Jeff, let's start with breaking news. The Federal Reserve.
Yesterday, the Federal Reserve, FOMC meeting happened, and Jerome Powell raised rates 0.25%. And, you know, the funny thing is, when they raise prime rates 0.25%, the mortgage industry, we look at things a little bit different. In fact, this morning, our rate sheets opened, and we were 0.25% better. Pricing actually improved, which means long-term interest rates are down, and there's a couple reasons for that. I took a couple of quotes from Jerome Powell's press conference, and these were things he said. Number one, he said that the labor demand was substantially higher than the supply. Okay, we'll get into that. Ty's going to talk a little bit about what labor force participation is and how unemployment controls the market. He also said that the last 90 days, our economy is showing that inflation is easing, okay? So they're raising rates, but the mortgage industry looks at the real data. So if inflation is easing, then more than likely we should be lowering long-term rates. And then the last quote that I'm going to pull from him was, the disinflationary process has started, okay? So the FOMC's whole focus is to curb inflation. They fight inflation by raising rates and tightening up the money supply. And sure enough, it's been working. We're all feeling it, but on the mortgage side, things are getting better.
I wanted you to clarify that because one of the biggest complaints that kind of makes me smile a little bit, that I get on my YouTube channels, I always get comments like, you're such an idiot, because they're like, you keep talking about how rates are going to go down or how mortgage rates are falling, but then, you know, the Fed just raised rates again. They're like, you don't know what you're talking about, you idiot.
They are not intertwined. Now, obviously, when the Fed is raising rates, there's a reason for that, but it is not directly impacting mortgage rates. There's bigger pieces to the puzzle that we have to look at.
Right. So am I correct? I believe mortgage rates follow inflation. So as inflation comes down, mortgage rates come down. We peaked in November, I believe, with inflation, and rates have been coming down since November. We're actually down more than a point.
Yeah, total. I mean,
November.
you know, when we look at peak rates in 2022, we were sevens. Okay, and honestly, when I say that, I almost get like PTSD, okay? But that wasn't that long ago. And now we're seeing interest rates very easily in the low fives and even some opportunity with a 4 in front. 4. Like, that's crazy. So mortgage rates are affordable. Again, we're at a place where people can absolutely perform.
A few months ago, I actually did a video, 5% mortgage rates coming soon. And once again, I got my butt handed to me by a lot of people who thought I was a fool. But there's so many things. We look at so many numbers, Jeff. There's so many things happening that are bringing rates down, and inflation is coming down. And one thing to remember, a lot of times people are really hard on the Federal Reserve because they always seem too slow to respond. And the reason they're too slow to respond is because they're looking at yearly numbers. We're looking at numbers like what happened yesterday, or last month, or where were we last month or the month before. The Fed is actually looking from a year ago. So if numbers were really good a year ago, it's going to make things look worse today. And if they're really bad, but they're looking a year. It's like, you know, I think Barry Habib, he's one of my favorites. Most of us, when we're driving, we're looking at the car, you know, in front of us, maybe down the road, you know, our turn's coming up. When you're looking at statistics, housing numbers from a year ago, it's like driving and looking in the rearview mirror. You know what I'm saying?
Absolutely.
So that's why they're slow to react.
Well, and plus, I mean, look, we could get into a whole political side of that slow to react. But in reality, you know, the Fed was dealing with the pandemic, and there was a lot of talk about what they call transitory inflation. Basically, like it's not real. Okay, and we all know that's not the case. Like we've all felt it. Like we know what inflation is as a consumer. We get it and we feel it. And so now that the Fed is realizing, okay, It wasn't transitory. It was real inflation. I mean, they've even come out. Jerome Powell's come out and admitted some faults, which I think is a big deal.
Right.
But they're not done raising short-term rates.
Right.
So, those of you out there that are thinking, oh, the Fed's going to keep raising rates, just remember, mortgage rates and the federal funds rate, they're two very, very different things. And mortgage rates themselves, they're driven more by inflation and unemployment numbers, and also a big one, application volume. Okay, how many applications a lender is making. So
right, and I did see last week an article that mortgage applications are up 28%.
Yeah,
that's a massive number.
Yeah, and I don't want to be a downer on that statistic, right? But if I looked over year, the total applications were down, right? Like 8, but a 22% increase from the month prior that's huge.
Right.
And I'm telling you, from my perspective, I absolutely feel it. I see it.
Yeah.
I see more and more people coming to market. They're realizing that opportunity that they have to buy is now, and waiting for interest rates to get lower or prices to drop. Like it isn't panning out for them. They want to be a homeowner now.
Right.
They want to buy today.
And we'll talk about at the end of the video how you want to plan that as a buyer and a seller coming into this market where we're at, because we are going to see price declines for a little longer. But so how to time that market, we're going to talk about that. But right now, I'm going to go to this first slide here because I'm going to do something fun. We're going to talk about the data from UtahRealEstate.com. This first one is from the peak in May, right? This is the house. This is for the whole state of Utah. So you can see up there, 6 days on market. Homes are selling in 6 days.
It's crazy.
In 1 month, over 4,000 homes sold in May. And with a median sold price for single family homes, I always look at the single family home number, is almost $600,000. That's pretty insane. Now, if we go to the next slide, this is the end of December. So from the peak to the end of December, we went from 6 days to 46 days on market. From over 4,000 to only 2,500 homes sold.
Yeah.
And your price per square foot's down $30, and median sold price is at $521.
4,000 homes sold versus 2,500 homes sold in a very short period of time. Now, obviously, you could say maybe that there's a seasonal adjustment there, but I would say no, because normally for me, I do a lot of purchase transactions, and December is almost always my busiest month, especially for new construction. And it was the slowest month I've ever had in my career.
Right.
So, that is a staggering drop, a staggering change when you think about it.
Right. So we go to the next one there. You see James Wood, he's one of my most trusted sources there, that housing markets can turn on a dime. And in Salt Lake County is going to be more extreme than Utah as a whole.
Sure.
And you can see their prices were around $650,000 at the peak, dropped all the way to $540 in December. So that's a $110,000 price drop.
Yeah.
Now, Jeff, it's important to remember, people were bidding 50, 60, 80,000 above asking price.
Yeah.
So in my opinion, really, it's just this is pretty close to where pricing should have just been.
Absolutely.
With normal market. So I don't think we're going to see a massive decline.
The data from 2020 to end of 2022, the average appreciation in the United States was 39%. So 39%. So you even look through the end of 22, 39%. So that's that just massive run up post-pandemic. We're coming out of, being in COVID quarantine, right? People buying and the supply not being there, demand being huge, that drove prices up. But now that correction is just, like you say, it's like where it should be. But we're not even close to where I would be nervous as a numbers nerd. Right. Not even close.
Like as far as a crash is concerned.
Absolutely.
That's just not going to happen.
We're not there. No.
So we've been talking about single family home pricing. This is all pricing. This includes townhomes and condos. That's why the number at 486 is lower than the 540 number that we gave earlier. But this just shows home prices in Salt Lake metro area.
Look at this.
Look at that.
Just crazy.
That is insane. But home prices just they go up over time, and that's because so does population. Right. Utah is one of the best population growths for a couple reasons: job growth and
top 5
internal growth as well. Right. And so this just kind of shows you like where we were in 2000, where we were in 2007, and where we are at the end of December. You can see that's even with the little tick down that we've had there. Salt Lake City historically is one of the most volatile markets.
Yeah, sure.
And this chart's great to kind of show that. But this is what I want you to kind of look at. we were up 20% and then down, up about 20% again and back down, up about 20% again and back down. This time we shot up to 27%.
Yeah.
So that's a significantly bigger jump than normal, than a normal jump.
Because you could take any graph or any data set, right, and you can make it look extreme depending on the time, right? Just look at the actual numbers, right? Talking 19.4% appreciation in the 70s, late 70s to early 90s, a 5.4% loss. The average consumer, they're not selling their home inside of that time frame, right? So they may be purchasing and they might weather 2 or 3 of these peaks, right? Like they get through multiple of them. So, you know, real estate traditionally is always a very, very safe bet. And I hate to use the term bet, right? But in reality, when people are buying homes, it's their single largest expense, and it's also their single largest asset.
Right.
And if you're there for the long haul, you're raising a family or you're there long term, 20%, 27%, I mean, those are numbers that are realistic over the lifespan of that home for you. Seeing a couple big drops like that never makes me nervous, because you could look at any stock and you could look at it in the same window and it'd be inside of a day of trading. You know, you could see percentages like that. Still a phenomenal way to invest, right, is real estate.
Well, and they say 2/3 of America's wealth is in real estate. It's from home equity and paying down people's houses. That's a whole nother video.
Totally, yeah.
So, okay, this map is great. This is talking about jobs. This is payroll jobs, right? Not real estate agents.
Yeah.
Right?
W-2 people.
W-2 people. You can look at Utah. We're number 2 only to Idaho, and those numbers are so close that technically, really, Idaho and Utah are number 1 in the whole nation. We have the strongest job market in the country, along with Idaho.
Yeah.
And so they always say you don't have recession when you have a great job market.
When you have job growth. You even look at the technical definition of recession.
Right.
And it's job losses. Yeah, not job growth.
I mean, that right there, if you live in Utah, that should make you feel pretty comfortable. One of my subscribers kindly reminded me the other day that the tech's crashing and Utah's gonna be in trouble. I just want to remind you guys, tech's huge in Utah, but it's like 10%.
Yeah, 11,
I don't know exactly.
Or something. Yeah,
I don't know the exact
it's a smaller number.
I mean, we've got so many great things going here that tech could completely crash and it wouldn't even hardly scratch the surface.
Yeah. At what point, Ty, do you and I want to talk about that labor number, right? Like what job growth means, you know, because ultimately when we look at the economy in general, right? And you think about what has been an issue, what has driven inflation, for the most part, especially in the services sector, it is wages.
Right.
Like employers are having to pay people so much more money because there aren't enough people to fill those jobs, right? Like there are 2 jobs, 1.9 jobs. Jerome Powell just released it yesterday. 1.9 jobs for every person that's looking for a job.
Yeah.
So that means they have choices, right? That's unique.
Right.
Okay? Unemployment's at some of the lowest that it's ever been. And in Utah being very strong. But when you talk about a tech crash or a sector that's crashing, at the end of the day, it's more of like a reset.
Right.
It's not a crash.
Just like the market.
Yeah. If employers can't afford to pay somebody at the rate that they've been paying, they have layoffs. But ultimately, there aren't employers just saying, hey, we're out of business. We just don't want to do this anymore. They're having to reset, consolidate. And that does mean 6 months later, there'll be job growth. So it's like this yin and yang thing, this cycle, this balance. And, you know, employers right now are paying too much. Things are going to have to get reset.
Yeah, I think the number I wrote down here was like 2.2%, and that's from the Bureau of Labor Statistics in Utah. That number is too low.
It
right?
is.
So let's so this just kind of shows you what's happening right here in Salt Lake City. Right? That is an uptrend. That is a good sign for housing markets.
You got this like crazy dip right there during the pandemic, and then it just shot from there. Within 3 weeks, you have just a turn and then just skyrocket. And that is a sign of inflation. The people need to look at it as what it is. If an employer has to pay an employee more, then they charge the consumer more. That's how it works, right? There has to be a balance. Okay. Corporations aren't in it for free, right? This is capitalism at its finest. And so we're finding that buoyancy right now with interest rates starting to drop a little bit, mortgage rates. people are realizing that houses are affordable,
Right.
right? And they're still feeling comfortable in their jobs, and so they're buying.
Right.
Okay, but this is starting to plateau, meaning that
Yeah.
the number isn't climbing as fast as it was, and that's a good thing. Like, we need to slow down.
Right.
Like, we need some unemployment because it is actually
Right. We're
healthy.
unhealthy. Yeah,
It's healthy for our economy to have a shakeup, and I
Yeah.
think it's actually healthy for employees that potentially get laid off, even because they get to reset. So
Right.
it sounds weird when I say that, right? But
Yeah, I love
it's
the
true.
point that you made that people are feeling good in their job. And so whenever I say something like, it's a great time to buy, or you should buy a home now, or anything like that, you got to remember, like, you always need to take your personal circumstances. If you're not comfortable, you should never buy a home.
Yeah, absolutely.
Right? If the numbers
Yeah.
are too tight or whatever. And
Right.
so
Yeah,
we want to remind you of that. All right, so this shows the Utah unemployment rate versus the national unemployment rate. You can see nationwide we're doing amazing, but Utah's crushing it. I mean, look how much that's
We're
significantly lower
better.
than the nationwide numbers. And so
2%, like, it's just
yeah,
I mean,
too low, right?
that says a lot about our economy, and we're talking about some growth.
right.
Some of the statistics that you can't see in this is, you mentioned the tech sector, having a retraction, right?
Right.
Or essentially losing some jobs. But where we're growing like crazy is transportation, right? You think about the companies that are coming here to Utah
Right.
that want to be here. A lot of them are bringing transportation jobs, drivers, to Utah, and that has been an exponential growth, like 15-16% growth.
Right.
And that helps keep our total unemployment numbers at a very, very healthy, too healthy probably, level.
The good news is, as prices come down, as rates come down, people will move back to Utah. That's the problem, is people don't want to move to Utah because the prices got so high, and then when the rates jumped, no one moved here, and employers literally can't find someone.
Or people that were in Utah left.
This is one of my favorite charts. I've gone in there and kind of highlight some things, but just talk really quick about why we will not have a market crash. Okay, if you think there's gonna be a crash, I don't know how else to say it, you're wrong. So if you look here, this is 2008, 2007, the Great Recession. This is today. The numbers don't lie. You might want to look back at this later, but look, 8 million job cuts versus virtually none. You come down here to total jobs. We're up 20 million. That's insane. We have virtually no subprime loans. We're down on the 5-year cumulative new home construction before the crash. We're actually down 3 million units. That's bad. Like, we need houses. We're having a housing shortage.
Right.
And then let's see, anything else I want to talk about on here? You got, inventory on the market, right? 1 million homes, 1.2. That's almost like that's not like a scary number.
No.
There's always going to be homes listed for sale as people, move around the country, normally. And then, of course, there's almost no foreclosures or delinquencies.
No, I think that's a big, important key. This is, proof in the pudding that when the pendulum swung out of the Great Recession and we tightened up credit policy and we, documented every bit of income, every asset, like every deposit. I mean, we kind of went crazy in the mortgage industry to make sure that borrowers could perform. We don't have defaults.
Yeah.
And even if people still lost jobs, right? Like, there's still like life events that happen, but overall people saved money. They have better credit scores. In fact, at the end of 2021, I pulled all of our closed loans for the prior 3 years, and we had an average FICO score of 746. Wow. And we had average equity of somewhere around 23%. Okay. Now that was prior to the continuing madness.
Right.
Okay. So like, that equity would have been people putting money down to buy a home. Okay. That's the big deal. People don't walk away from a huge amount of equity.
If you have a home and your mortgage payment is cheaper than rent for a similar house, because you have a 2.875 fixed 30-year rate, and you bought before the house is shot up, it's like you can do everything in your power, and especially if $100,000 or $200,000 of equity in that property to keep that house. Even if you have to go, wait tables, or it pays really good nowadays. You get like $19 an hour plus tips.
It's true. Those employers are paying the money.
Yeah, they are.
Yeah, but I think that's a big key
graph
to understand. is there a potential crash? That's like a big topic that people want to focus a lot of energy on. It's like, hey, I'm going to wait because it's going to crash. I work with a lot of builders. So do you, right? Yeah. They're holding on their inventory. They're not desperate at all. And so they've corrected prices. They realize, like any builder, when they were getting 40+% margin way back in the day, that was probably too much. Right. And so now that things are slowing, they're holding their prices, which is important because that maintains value. Okay. It means that people that bought in that neighborhood, earlier, they still have value. They still have equity. They're not getting undercut by the builder or existing, owners, right, that have to sell because of a default. And that shows strength, not impending doom. So if the delinquency number was higher, I could say, there could be some justification, but you have low delinquency, high employment. We're not seeing a crash.
You can't have a crash if homes don't go into foreclosure.
Absolutely. That's how it works, right?
Okay, so this just shows inventory. We are in Utah. This is national numbers, but Utah is very similar to these numbers. You can see the Great Recession up there in the top there with the red circle. We had way too many homes. And then as it came down here, guess what builders didn't do? They didn't build homes. For the full decade after that, it dropped home. So we never actually caught up. And so you can see that blue line is where we should be. We're far below that.
Way below it.
And this little thing that just happened, this little 6 to 8 months where rates hit 6% or 7% above and nobody bought, guess what builders stopped doing? Building.
They just sat tight.
So what happened again? So when we come out of this again, we're going to be short on homes again.
It's such a funny thing because it really is just the basic laws of economics. Supply and demand. If the supply is short and the demand is there, people are going to pay more. And when you're talking about housing specifically, there's a very emotional connection that gets made with the house. And so when people are buying, it's not just a logical decision. And so, that being said, they will pay more if it's the house for them, if it's the right house. And if they can afford it, that's always been a key. But if the supply continues to be this very, very short supply, our house prices are going to stay. They're just not going to fall.
That's why the market's going to turn around faster than most people think. And mortgage rates, they're coming down.
Like I said, just at 0.25% in one day, But over a 6-month period, we've seen like a huge correction. That's pretty massive.
And I saw some statistics that said if rates hit 5.5%, you have buyer support at that number, 5.5%. So I think before that, people are going to start pouring into the market. They're going to see it coming, and they're going to know, that it's time.
Agreed. So, I think that's a good key indicator.
So Jeff, the big question is, should I buy now or should I wait? That's kind of the big question for people. And so kind of my theory on that is I want to buy before the market turns. I want to buy before rates hit 5.5%. To me, that's what makes sense because I want to be ahead of the curve. Right now, I can still negotiate with a seller. I can get them to pay my closing costs, maybe a rate buy down or whatever. As rates approach 5.5%, that's going to get less and less likely. The other thing is, if we're coming into the normal buying cycle, this is the normal hottest time of the year that we're coming into. And so I think that, along with decreasing mortgage rates, home prices have already, you saw in Salt Lake City down 110,000 in December, probably more than that, obviously more than that now. So we've already had a massive correction.
So I'm going to throw my 2 cents in. From a lender perspective, I look at things, I'll say your perspective is absolutely right. You're trying to time it, I look at more of can you, Can you? And you should absolutely buy a home if you can afford it. It doesn't matter what the rates are. And I know that sounds, almost like heartless or like impossible. It really doesn't matter what the rates are. If you can afford the home at that price with that rate, you should purchase because it's so much better than being a renter, than paying somebody else for your housing. And you can always refinance. There's always an opportunity to save money in the future, and that's what I teach people. That's what I do. So is it time to buy? If you can afford it, absolutely. Buy a house. Be a homeowner.
So I agree with you 100%. Homeowners are over 40 times wealthier than renters. Not 40%. 40 times. That's insanity. When we're showing the charts and the ups and the downs and all that stuff, it's important to think home prices already dropped in Salt Lake County, probably $120,000, $130,000 from the peak. Is it a good time to buy? Heck yes. If prices even fall another $20,000, if you look at the 40-year, the 30-year loan or the rest of your life that you own that property, you can build excellent equity as long as you can afford the house payment. There's a lot of creative things you can do. Right now, a lot of things I do with my clients, we're talking about seeing if the seller can pay for the closing costs or the rate buy down. In some cases, both. What's a normal rate with a buy down people can get right now? A simple one.
The average market rates are right around 6.1% still. You're going to be able to buy into the mid fives, no problem, with very minimal cost. So
and that's where buyers come back into the market.
Yeah, absolutely.
Right, so you're already there. You can get that right now. And so that's what I want to get across to those of you who are watching. The thing about buying a home is you want to be ahead of the curve. If you wait and home prices go down $20,000, but then you lose all negotiation power, guess what you're doing? You're paying $20,000 of your own closing costs.
Sure.
And a rate buy down or whatever.
Which could get you back to can I? If you can't afford it at that point because you don't have the cash, then you miss the opportunity.
What would I say?
Don't ever wait if you can perform. Trying to time the value of the market. I mean, we just showed statistically where the likelihood of values dropping further is slim, right? So it really is about affordability and how long you're going to be in the home, how long you intend to be there. So if it's long term, buy now, buy today, if you can afford it. If not, get yourself to a place that you can. So,
and the top economists always say that. It's like, you buy a home when you can. I've heard like Dave Ramsey say it a million times, right? Is if you can afford a house,
buy a house.
You buy a house. And if you bought a house in May of last year, that was really bad timing.
And this is a matter of opinion a little bit, right? Really bad timing if you bought May of last year if you were selling today.
Right.
If you were selling today, then you know what? Dang it. But if you bought a house in May and you don't intend to sell for 10 years, then it was absolutely the right time to buy.
Jeff, can you go back to the 2008 chart? If you purchased at the peak of the market, you spent $280 for your house. If you just been like, I'm sitting on this baby, I'm just going to sit on it, like a lot of us did, right? Guess what? That's a massive upswing from 2008, and those people were like, oh my gosh. I remember thinking to myself, oh my gosh, we lost so much equity.
What am I going to do?
Right? It's just like, you're just, that we're fine with the house payment. We're just like, oh my gosh, we just lost so much equity. Right? And it's like, don't panic. It's okay. Like, don't panic. We've shown you, that's what it goes up. The population goes up. The jobs are going up. Just hang in there. And if you can buy a house, it's way better than paying rent. Like, you got to buy a house.
So Ty, what are we going to do on our next show?
That is a great question.
You're going to give them some more info. I'm kind of stoked to do some research.
So we're going to talk more about what current inventory is at. What current rates are at, so you guys can know. And then we're going to talk about affordability. The whole point of this, guys, is to help you. That's why we're doing this, so you know how to time the market. I hate to use the word time the market because when I say time the market, Jeff, I mean if you can buy a house right now, that's the best time. And because we've seen such a massive price reductions, it's a good time. You're not going to have to worry about another $100,000 in price reduction. That is not going to happen. We have too little inventory. I want to ask you something, because I hear a lot of people talking about the rate buy downs, and a lot of people think that's a mistake or whatever, or it's not worth the money. I personally think, because where things are at, and I think you agree, that a 2-1 buy down maybe is not the best decision now. You might as well just buy down the whole rate and just have a permanent buy down, guys. Here's the question. I have $10,000. Is it smarter for me to put $10,000 down on the house or buy down the rate?
The way I'm going to answer it is it really depends on the customer. But, if both customers were exactly the same, let's say we're comparing two. One's going to take $10,000 and they're going to reduce their purchase price, and one's going to take $10,000 and reduce their interest rate. And you're just looking at the monthly savings.
Right.
And you're talking about a 30-year fixed loan.
Right.
Okay. That $10,000 price reduction is going to make a savings of somewhere around $60.
$10,000 down, you save $60 a month.
Exactly. Yeah, it's super easy, right? Rates are around 6%. Like, the math is easy.
Right.
Okay. But that $10,000 in reducing the interest rate, it's going to save more like $150.
Right. Depending on the house, a couple hundred.
Yes, permanently. So, if somebody looked at it and they're like, well, I only need that $10,000 for a temporary period because I'm planning on selling or I'm going to refi. Well, then let's do a price reduction. But that's the whole point, is to have experts that will walk you through the numbers with transparency, so that you can make an educated decision. So today, a permanent buy down is going to make more sense than just a $10,000 reduction for the average customer.
Jeff and I are both very, education is really important to us. We will take the time to educate you. And I can say with 100% confidence, you can call Jeff. I'm going to put his phone number, his contact information in the description below. Mine will be there as well, obviously. If you need to talk about, is it a good time for me to buy or sell my house? I have some opinions on that as well.
Yeah.
And I'd love to come meet with you and talk to you about that. Jeff is willing to meet with you whenever.
Absolutely. Yeah.
And so please reach out to us if you have any questions. Other than that, Jeff, I think that's it.
We're going to set a benchmark today because we're going to be tracking interest rates. I think that's such a key piece right now to our decision of when should we buy, right? It affects affordability. Today, average across the country, and this is multiple lenders, okay? So this is unbiased. This is not me pulling from my company. This is data that anybody could get. 5.99% to 6.19% on average, okay? So we're going to say, 6% essentially is the average 30-year fixed rate today with minimal points. That's what it is. So in a couple weeks when we do this again, we'll pull market data at that point and we'll start, tracking this for you and equate to what that is in buying power for you. Right. So if you're thinking about buying now, you'll see what a small change in interest rate can do for you, but more importantly, you'll see how quickly this data can change. Cool? So
perfect.
Ty, thanks for having me, man.
Thank you.
Appreciate it.